kind of a light data week this week, but there were still a few nuggets that we can pay attention to and might have generated some ideas. So hopefully, let's see if we can get something useful out of tonight. The RBA, Reserve Bank of Australia, they indicated they were close to the end of their interest rate hikes. So the market got very excited early in the week and rallied higher, a very bullish tint, but that faded pretty quickly given other releases later in the week and some comments from the Fed. What it did result in is a continued strength in the US dollar, and that's likely to continue if central banks elsewhere in the world start tapering or finishing off their interest rate hikes and the US continues to hike moving forward. That's going to push the dollar higher and higher, and that's one way to play it if you want to buy the dollar, if you believe that. The other way you could play this move is to short exporters, especially exporters who rely on the majority of their profits from abroad. For example, thinking of Coke right here. You could also look at Procter and Gamble. And you know how I love Tier 1, Tier 2, and Tier 3. P&G and Coke are Tier 1. Tier 2 is key suppliers to the goods they sell abroad. Tier 3 is key suppliers to their key suppliers. So something to look at. That was the first bit of this week that I thought was useful to look at. And we'll move on next to Fed Speak. So there were a number of Fed speakers this week. And while the market started off higher, thanks to the RBA early in the week, by midweek, that was gone. The indication from the speakers, they were pretty clear that rates are going higher, going to continue to go higher, and they're going to continue to remain higher for longer than people expect. To sum up, that means forget your pivot. It's not happening. That pressured stocks the rest of the week, and that's what you got to carry forward. Don't look for the pivot. Stocks are going down. Interest rate stocks are going to get hammered. We're almost certainly going into some sort of recession. So discretionary stocks, luxury stocks should all be pressured. Things to look at if you want to be on the short side. On the long side, you could look at, for example, consumer staples. And you could play that individual stocks or via ETFs. And if you're wondering if we're going into recession, are the indications there? Yeah. AMD produced a horrible earnings number, pre-announced. They got absolutely slammed for that. And then FedEx also pre-announced for the second time in less than a month. They cut their estimates. So the Fed is telling you we're going into recession and we're okay with it, basically. The third piece of the puzzle this week was the jobs numbers. Obviously, they were supportive of continued increases in rates. There was no major miss, although in the midweek there was a reduction in the number of openings out there by over 1 million. But still, there's more openings than there are people looking for work. So, the theme taken from everything happening, including the OPEC oil cut of 2 million barrels, is rates have to go higher and they have to remain higher. So trade accordingly, and I think you'll be in a safer position, either short or out. As I mentioned, consumer credit is not a big number normally, but this time it's interesting to see what's happening to the consumer. And man, the numbers are shocking. Consumers are borrowing like crazy and using their credit cards for revolving credit, and they're just digging a deeper hole, maybe having no plan to pay it back at some point. We'll have to see, but it's definitely a sign that the consumer is struggling as the interest rates are going higher. So the cost of carrying that debt is getting higher. So the pain is going to go up. So another interesting data point. Okay, that's it for this week. I hope you have a good Fed weekend, at least a better one than this guy will have. See you Sunday.